Welcome to Strategic Management. I think that is MBA 210, if I'm not mistaken. So we'll be looking at the preliminaries of strategic management, the principles of strategic management, and how strategic management relates to an organization. So that is strategic management, and this is session 1.0. So we're going to delve into what these two elements are. If I can just complete that term so that we are in line. Management. I'll give you a few highlights of what we are going to look at in the coming sessions. First and foremost, one of the first things I always want to do during a preliminary of any topic, the principles of any topic, is to understand the core terms of that particular topic. So we have strategy, and we have management. So we'll be looking at strategy and what strategy is, and that is a principle that is derived from the army. Strategio, in fact, the key term is strategio. Strategio is a military word that was used a long time ago on how the army was going to invade a particular territory. So you're talking about one military engaging another. They have to find out what the other territory is like. They must find out what if it's an enemy, how many soldiers they have, what type of tactics they have to employ, what type of machinery, equipment, or artillery they would have to go with so that they attack their enemies. So they have to find a strategy. What time of the day they will have to go there, what type of operation they will use, what type of tactic they will use during their operation on that particular mission. So strategy is related to a business forum or a business environment. And in a business environment, you also employ the same tactics. You have to find out what product you are selling. You have to find out who you're selling the product to, what season that product is. Okay, so we'll be looking at the internal strategies. We'll also be looking at the external strategies. Okay, got the internal strategies, the external strategies. What do you mean by internal strategies? Okay, before you employ to sell a particular product, you need to know within yourselves who is capable of selling that product. We have marketers. Some people are good at accounts. All they do is accounts. All they do is sit and play around with figures. That's all they do, and that's what they're good at. So you take the accountant to go and do marketing. Excuse me. That's a wrong strategy, because the accountant is basically an accountant. So all he does is focus his attention on the figures. So to go and ask him to spend 30 minutes to employ a strategy verbal acrobat, it won't work out. It won't work out. So you need to know who you're sending to do the marketing. And within yourselves, you need to find the right human resource to do what. So you look at what product you're selling. So you need to sell product A in a particular location, and you know who is going to sell that product. You know who is going to do the marketing. So you create a workforce around you based on the product you are selling or service that you are providing to your consumer or to your customers. So in that respect, you need to perform a very good strategy that is internal, that is going to go out there and create an oomph, if you like. Okay, that is going to create a big impact in relation to the product that you're selling. So we're going to look at translation of the mission of an organization or the objective of an organization into reality. So in strategy, we get the organization's mission, objectives, aims, and we translate those out there so that we are able to say the organization's mission is to do A, B, C, D. And we find out the internally who is able to help translate that mission so that the organization moves forward. And we also need to understand strategic planning, strategic decisions. We need to understand the organization's limitations. So all those are strategies. You also look at the SWOT analysis. You look at the strengths, the weaknesses, the opportunities, the threats. You put all that together and you gravitate that into a strategy. Okay, that's internal. Now, I talked about external strategies or external factors. You look at who else is the competitor out there. I'll give an example of Boom or a detergent paste. If you are going to sell off a detergent paste, who is your number one competitor in that arena of a detergent paste? Okay, where is he or she, or where is that particular product or service greatest? So the force you are fighting against externally, what are the external factors? You look at the POIC, that is the planning organization. You plan the external factors, you look at them and you find out which ones of these are a hindrance towards the selling of our product or service. Okay, so that is strategy, taken from the term strategio. And you look at management. Management is one of the most how can I put it? One of the most robust arenas, because in management you have a lot of levels. You have factors of management. You've got quite a lot of these things that realm in. So when you talk about management, you're talking about we'll be looking at Henry Fayol and his 14 principles, Frederick Taylor and his 5 principles. That's where the planning comes in, the influence, organization, communication, and we also have got different factors that we'll look at in terms of management. How your management setting is like, how your hierarchy is, how quickly does information get to the top, and vice versa, how quickly does information get from the top to the bottom. So the aspect of strategy in relation to management is equally important. So you look at management in its own individual capacity, in its own world. Look at who is to do what, which manager is to execute which task, and which other parties will execute what type of arrangement, and we talk about the human resource and all that. Now, strategic management in all or in essence aligns your vision, of course. It aligns your vision and mission towards the organization's goal. So you can take note of that one. So you collect your mission, you collect your goals, you collect your objectives, you collect your vision, you bundle them up, and they gravitate into one direction with a goal. Not just a goal, but a non-goal. Okay, so that is strategy, and that is management. Coupled together, that is strategic management. You are now coupling in all factors that relate to the organization. All right, now we talked about strategic, talked about internal strategies, external strategies, we talked about management. Now, let me just put this into perspective. When you look at financial management, managerial management, I'm talking about the finance world now. Financial management, managerial management or managerial accounting, and accountants. Okay, these are three different levels. So we've got financial management up there. The next we've got managerial management or managerial accounting. Then we've got the accountant down. So what happens in this realm is, up there you've got the directors who look at big figures. So they would say the institution needs 1 million, needs to make 1 million by the end of this month. So this month's target is 1 million. Now, for us to make that 1 million, we need 200,000 kwacha, if it was in kwacha, or $200, 200,000 kwacha as a prefix amount for the organization's day-to-day running. So all they know is that, okay, we've got 5 vehicles we're supposed to use, we've got 10 employees, and we have electricity, rentals. So all that is coupled in the 200,000 kwacha in principle. But we're supposed to make 1 million. That's the target. So now, in terms of 200, that's the one we give to management to make their errands, fuel, blah blah, utilities, and all that. Okay. So that amount is trickled down to the management. Managerial accounting now looks at the specifics. How many vehicles do we have? Okay, we've got 5 vehicles. How much fuel does each vehicle need? Okay, each vehicle needs maybe 1,000 kwacha. Okay, so you know what? Okay, each vehicle needs 1,000 kwacha. But now the question in specific, that's where the difference is between finance and management. Finance looks at the whole, looks at the total 200,000 kwacha, but can in 200,000 kwacha can say, okay, in 200,000 we have 3,000 for fuel, we have for argument's sake 50,000 for remunerations, okay, and we have an extra. So they budget them in lots. When it comes down to managerial accounting, it's now that lot of 3,000 kwacha for fuel is now disintegrated into how many vehicles do we need, into who needs fuel at what point. The strategy is coming into play. Who needs fuel at what point? Do we just get this 3,000 kwacha and put it all in one tank? No. Now, since we've got 5 vehicles and we've got 3,000 kwacha, if you divide that, it will mean we'll use 500 kwacha in each tank in the 5 vehicles. Now the question is, does each of those vehicles, in terms of the errands that they do, require the whole 500,000, all 500 kwacha? The answer might probably be no, because if one of those vehicles is the director's vehicle, the only thing it does is take him home, bring him for work. The car is parked the whole day. You probably will put less fuel, of course, probably enough for him for the whole month or her to go home, come back for work, park the vehicle the whole day, in the evening knock off, get the vehicle, go home, come back for work. So, and then you have the utility vehicles. The utility vehicles is the one that moves around, you know, to do the marketing, the sales of their services or products, you know. So that's the utility vehicle. That's the vehicle that you need to push in a little bit more fuel so that you know the company's errands are met. So the management will also disintegrate that amount into who needs it the most. Then you've got your employees. Of course, you have a chain. You know that employee A gets this much, employee B gets this much. So finance will just say a lump sum amount is this amount in management. Then the accountant finally now disbases. So the accounting is the disbasing wing. Or they say is, oh, fuel for registration number A B C D 1 2 3 4 has been allocated this amount of money. employee A has been allocated this amount for his salary, for his pay, and it goes on like that. So now, that is in your strategy, and that is in your management. So management talks about the hierarchy, who is doing what at what level. Okay, the directors in finance do not get the money and give the driver to go and put fuel. No, they get that money, that allocated money, as they do their financial management, and hand it over to managerial accounting. Managerial accounting is the one that collects that money and now specifies who's to collect what money when. Because sometimes even the when comes in. And gets that amount of money with the budget allocation to it and gives it to the accountants who do the disbursement. So now that is the strategy, the management level you have used. You have pointed out that each individual section will perform a particular task. So you are following management principles. The strategy you have used is, you have shown that, of course, you've mentioned that management, the part of management is going to do A, B, C, D, but you have employed a particular strategy in that this part of managerial accounting is only going to be reliable for or liable for ensuring that a particular figure is distinctively gauged or given out to a particular element or individual. But they are not the ones disbursing, because that's the strategy you're using. We want accountability on that form. And then the accountants don't plan for the money. All they do is collect the money as it has been written and tabulated for, and disburses it. You want questions? Go and ask top management. So you've employed a strategy, and you are using the management principles, and together you are able to use the strategic management principles